Okay, let's try and unpack this because
Yeah.
it's kind of wild. Imagine a small tech company, right? They announced this potential $20 million cash windfall from settling a patent lawsuit.
Sounds great on the surface.
Yeah, that sounds good, right?
What?
But what if I told you that on the very same day, its stock value just evaporated, like by over 70%? How does that even happen? I mean, this isn't just a market blip. It feels like a seismic event. And it forces us to ask, is this some catastrophic market overreaction, maybe creating a once-in-a-lifetime buying opportunity?
Oh.
Or is it the painful, maybe overdue popping of a speculative bubble, revealing, a fundamentally flawed business underneath it all?
Right.
We're diving deep into Neonode Inc., ticker symbol NEON. And by the end of this deep dive, you'll hopefully understand why its future might truly be a binary bet. We're talking potential outcomes from less than $2 a share, maybe all the way up to over $20.
And today, September 4th, 2025, really marks a critical inflection point for Neonode. They're headquartered over in Stockholm, Sweden, basically an optical sensing technology company. And we're going to use our sources here to really dissect its business model, the leadership, its financial health, and the, extreme market sentiment surrounding it right now, plus its ownership structure and the huge risks and potential opportunities it presents to investors.
Our mission, as always, is to arm you with the most important nuggets of knowledge from these sources. We want to help you navigate this pretty complex story and understand what's really at play here.
Yeah.
We've structured this deep dive into 7 clear chapters, split into 2 main parts, just to give you a comprehensive picture of Neonode's fascinating, maybe volatile journey. All right, let's kick things off by understanding the company itself. We'll begin with Part 1 and Chapter 1. Business analysis. What does Neonode actually do?
Okay.
And here's where it gets really interesting. Neonode's business model has undergone this radical transformation. Late 2023, they made what, you'd probably call a bet the company kind of move, discontinuing hardware products like their touch sensor modules or TSMs to focus exclusively on high-margin intellectual property, IP licensing.
Right. Just the IP.
Why such a drastic pivot, though? Well, their 2023 financials showed product sales actually had a negative gross margin.
Yeah, I saw that. They were losing money on the hardware.
Exactly. Losing money on every piece of hardware they sold.
What's truly insightful here, I think, is that this wasn't just some strategic choice. It feels more like a necessary retreat. It fundamentally redefines Neonode. This drastic shift from hardware to pure IP, it reveals this profound, maybe historical inability to build a viable product business. It basically forced them into this high-stakes, all-or-nothing gamble on their patents. That's their sole path to survival now.
Wow.
So this means their operations are now streamlined into 3 main revenue streams: license fees from embedding their patented tech, then non-recurring engineering or NRE for bespoke development projects.
Okay.
And critically, patent monetization, which is, front and center with this recent Samsung settlement.
So if they're all about IP now, what exactly is this patented technology? What kind of problems is it supposed to solve?
Absolutely. So at its heart, Neonode's patented tech is all about improving how humans interact with machines. It's built on 2 distinct platforms.
2 platforms, okay.
The first is Z-Force technology. It's an advanced optical sensing tech, uses an invisible grid of infrared light.
Infrared.
Yeah. And this lets you have touch on any surface, also contactless touch. Think post-pandemic elevator buttons, that kind of thing.
Right, hygienic touch.
Exactly. And even mid-air gesture control for things like holographic displays. Pretty neat stuff.
Okay, and the second one?
The second is the multi-sensing platform. This is software using computer vision and AI, mainly for driver monitoring systems, DMS, in vehicles.
In cars.
Yeah, tracking driver alertness, where they're looking, passenger presence, things like that.
This does sound cutting edge. But what's their real-world footprint? I mean, after this crash, we're talking about a microcap company, market cap around $100 million.
Yeah, roughly.
They seem like a niche player, especially being, a Tier 2 provider in automotive?
Right, Tier 2. And this raises that important question. What's their core value proposition, really? It's providing these patented, customizable optical sensing solutions for these next-gen interactions. So for customers, maybe that translates to differentiated products with hygienic contactless touch or rugged industrial gesture control or advanced automotive safety features.
Okay.
But despite having like 90 million legacy product deployments out there, their trailing 12-month revenue, TTM revenue, is only $2.61 million.
Wow, only $2.6 million TTM.
Yeah, it's stark. It really shows the gap between those past hardware deployments and what they're actually earning now from this new IP model.
Okay. Are there tailwinds for these technologies, though? I mean, contactless interfaces are booming post-pandemic.
Sure.
And those new EU safety mandates requiring driver monitoring systems in all new vehicles, that sounds like a huge potential boost, right?
It does sound like it.
But what about the competition? Are they alone in this space?
Well, while those trends are favorable, converting them into actual large-scale licensing deals is proving slow. In the touch market, their main rival isn't really another optical system. It's the dominant, much cheaper projective capacitive technology. You know, the stuff in basically every smartphone.
Right, the standard screen tech.
Exactly. Neonode just can't compete on price there, so they target niches, industrial, maybe military applications where you need glove use, or immunity to electromagnetic interference is critical.
Okay, specific niches. And in the driver monitoring space.
Yeah, in DMS, they face established, well-funded players. Companies like SmartEye, Seeing Machines, and Xperi. Big names.
Right, so not an easy path in either market. Regulatory tailwinds in automotive are helpful for DMS, but the competition's tough. What truly protects them then? If their tech is so niche, what stops bigger players?
The single most important barrier, and frankly, it's their lifeline, is their intellectual property.
The patents.
The patents. They hold over 100 worldwide. This patent estate, it's their crown jewel. It underpins their entire licensing model, and it fuels these high-stakes lawsuits against giants like Samsung and potentially Apple.
It's really all about the patents.
It really is. I mean, this isn't just their only advantage. It dictates their whole strategy. They don't have the brand recognition or scale or cost advantages.
Right.
So Neonode is inherently vulnerable. They have to aggressively defend and monetize this IP. It feels less about product innovation now and more about being a highly specialized, maybe litigious patent vehicle.
Okay, that paints a picture of the business.
Yeah.
Let's shift focus now. Moving on to Chapter 2. Management evaluation. Because, who's steering the ship really matters, especially at a critical time like this.
Absolutely critical. Neonode is currently navigating a pretty significant leadership transition. Back in March 2025, Daniel Alexis became the new CEO.
Okay, new CEO.
Yeah, succeeding Dr. Urban Forssell. Alexis comes from Ericsson. He was global head of innovation there, founded Ericsson One.
Interesting background, innovation focused.
Right, and that background seems to signal a clear intent from the board.
Yeah.
The focus now is on aggressive monetization, not just R&D.
Got it. Less science project, more business. What about the CFO?
The CFO, Frederick Nyland, he's been with Neonode since 2021, and he actually served as interim CEO for a bit before Alexis came on board.
Okay, so some continuity there.
Yeah.
Now, transparency and trust are key for any company, especially one relying on, lawsuits and future promises.
Yeah.
What's their track record here?
Well, they adhere to standard SEC reporting, which is, the baseline good practice.
Okay.
However, if you dig into the company's history a bit, there are some, let's say, significant governance concerns from the past.
Oh, like what?
There was a 2014 investigative report detailing pretty serious allegations of fraud against a former executive chairman, Per Bistedt. Involved shell companies, investor losses.
2014 is a while ago, but still.
Right, it's dated. But the Neonode entity itself also went through 2 bankruptcies before its current iteration, so that history warrants some caution.
2 bankruptcies.
Yeah. And furthermore, their heavy reliance now on patent litigation, while perfectly legal, it can be controversial for some investors. People who prefer companies generating revenue from actual products or services, not primarily lawsuits.
Right, that makes sense.
Yeah.
So given their financial struggles historically, how have they used their cash?
Yeah.
Have they been, returning value to shareholders? Buybacks? Dividends?
Quite the contrary, actually. Neonode has never returned capital to shareholders. No dividends, no buybacks.
Never.
Never. Their history is one of consistent shareholder dilution. They keep issuing new stock offerings, essentially selling more shares just to fund their operations.
So shareholder stakes get smaller over time.
Precisely. Capital allocation has been heavily skewed towards R&D, which led to that significant cash burn we'll talk more about. Their future strategy now likely involves less R&D and more spending on sales, marketing, and especially legal expenses for all this licensing and litigation.
Okay. And what about their return on invested capital, ROIC? Are they actually profitable with the money they do invest?
No. ROIC has been consistently and deeply negative. That's a major red flag.
How negative are we talking?
For example, in 2024, it was minus 1,169.6%.
Whoa, minus 1,100%.
Yeah. It quantitatively demonstrates management's historical inability to generate any profit from the capital they deploy. So this anticipated $15–20 million from the Samsung settlement. It's a real watershed moment. It's their first substantial non-dilutive financing in recent memory.
Non-dilutive meaning they didn't have to issue more stock for it.
Exactly. But the market's violent reaction to this news, maybe it reflects a fear that this windfall won't be returned to shareholders or deployed transformatively. Maybe the fear is it'll just fund more unprofitable operations until the next crisis.
A valid concern given the history. Okay, let's really dive into those numbers now. Time to crunch them in Chapter 3. Financial analysis.
All right.
First off, market cap. After that September 4th crash, it stands at approximately $100.38 million.
What that's about?
That's based on 16.78 million shares outstanding. Tells that 5.98 price. But wow, that's a staggering destruction of shareholder value. It was over $360 million just the day before.
It's brutal. And looking at revenue growth over 5 years, it's just a persistent decline. From $6 million back in 2020 down to $3.1 million in 2024.
And TTM is even lower.
Yeah. As we mentioned, trailing 12-month revenue is even lower at $2.61 million. Just a clear negative trajectory on the top line.
Good, top line shrinking. What about margins? Now that they're focused on IP licensing, are they actually making money on what they sell?
Well, here's the interesting part. Their gross margin is exceptionally high. We're talking 96.55% TTM.
96%, that is high.
It is. It reflects those attractive economics of IP licensing where your direct costs are minimal. However, this is completely overshadowed by their inability to cover operating costs.
The catch.
The big catch. Operating margin was minus 266% TTM. Net margin minus 241%.
Minus 200%.
Yeah. So this massive gap shows that while licensing is profitable per unit or per deal, their total revenue is simply nowhere near enough to cover fixed costs like R&D, admin, all that overhead.
So, okay, high gross margins on paper, but massive operating losses overall. Are they at least generating cash? Can they sustain themselves?
Unfortunately, no. Free cash flow has been consistently and significantly negative, just persistent cash burn year after year.
Like you burn.
From 2020 to 2024, their cash from operating activities ranged from negative $5.75 million to negative $7.68 million annually.
Burning $6 or $7 million a year.
Yeah. This multi-year cash burn is a fundamental challenge, and the company has this long, unbroken history of reporting net losses every single year.
Okay, that's a lot of red flags on the income statement and cash flow. Is there any financial upside, any stability we should be aware of? How's the balance sheet look, for instance?
Actually, yes. One key strength, maybe the key strength financially, is their pristine balance sheet.
Really? How so?
Minimal debt. We're talking just $485,000 in debt against $12.65 million in equity. That gives them a tiny debt-to-equity ratio of just 0.04.
Okay, very little debt. That's good.
Very good. And their short-term liquidity is also strong. Current ratio is 6.50. So they have plenty of current assets to cover current liabilities.
Right. So that provides a crucial buffer, a cushion for a company that's burning cash, buys them time.
Exactly. Buys them time for these legal strategies, these patent plays to potentially work out.
But still no dividends. Ever, right? Just to confirm.
Correct. Zero history of dividends for shareholders.
Okay. Given these numbers, which honestly paint a pretty stark picture, how do we even begin to value a company like this?
Yeah, it's tough. Traditional price to earnings, PE ratio, meaningless. They have consistent losses.
Right.
Price to sales, PS, it's extremely high, like 152.48.
Yeah.
That clearly tells you the market isn't valuing them on current sales at all.
It's valuing the potential future, the speculation.
Exactly. It's valuing those speculative future windfalls from litigation. Now, for intrinsic valuation, you'd normally use a discounted cash flow model, a DCF.
Forecasting future cash flow.
Right. But for Neonode, trying to pin down a single DCF value would be, well, misleading. It's just too uncertain. Instead, if you run an educational DCF model, what you get is an extremely wide range.
How wide?
We're talking from potentially less than $2 per share if the Apple litigation fails, all the way up to potentially over $20 per share if they score a major settlement there.
Wow. Under $2 to over $20. That's about as binary as it gets. What are the key assumptions driving that massive range?
The single most critical and most uncertain variable is the growth rate, but not typical growth. An optimistic scenario basically needs to model a huge one-time cash inflow, hundreds of millions from a potential Apple sell.
Okay, so it hinges on that big win.
Massively. And the other key factor is the discount rate. You'd need to use a very high discount rate, maybe 20, 25%.
Much higher than usual.
Much higher, to account for the extreme risk, that binary litigation outcome we just talked about, and the stock's crazy high volatility.
All right, that wraps up the fundamentals. Let's move into part 2 of our deep dive, shifting focus to the broader market dynamics and the future outlook. We'll start with Chapter 4, Market Sentiment. How is the market feeling about Neonode right now?
Well, after that crash, not great, as you'd expect.
Right, analyst coverage is pretty sparse for a company this size anyway.
Yeah.
There was an average 12-month target of $16.50 cited before the stock collapsed.
Yeah, it's totally obsolete now.
Completely. Ladenburg-Thalmann immediately downgraded it to neutral with a $6 target right after the crash. So what exactly happened on September 4th? Why did the settlement news cause such devastation?
The dominant story, clearly, is that 72% stock decline, despite getting $15–20 million from Samsung. The media tone was just widespread shock.
Yeah.
It's really a classic sell the news event. The market, you see, wasn't valuing Neonode as an operating business at all.
No, it was valuing it
as a speculative call option. A bet on massive legal victories. The stock's huge run-up, over 200% before this, was fueled entirely by hype around the potential size of the Samsung and, more importantly, the Apple lawsuits.
People were dreaming big.
Exactly. Multi-hundred-million-dollar figures were implicitly priced in. So when the Samsung settlement came in at only $15–20 million, while that's significant cash for Neonode itself...
Yeah, it pays the bills for a while.
Right. But it paled in comparison to the hype. It effectively repriced that option value downwards, sharply, leading to the collapse.
So the narrative shifted instantly.
Instantly. From, wow, how much are they going to win? To, is this all there is? And what if they lose the next big one against Apple? Big shift in sentiment.
Okay, that makes sense. Are there other market indicators confirming this really intense bearish sentiment right now?
Oh, definitely. Short interest is high. We're looking at 1.33 million shares short.
How much is that as a percentage?
That's 10.22% of the float. Pretty significant. And the days to cover ratio is also high at 4.63 days. That indicates strong bearish conviction. It would take over 4 days of average trading volume for all shorts to cover their positions.
So a lot of people are betting against it.
Yes. And technically, the stock chart looks awful. It's in a deeply bearish position, trading dramatically below both its 50-day moving average, $5.98, versus $24.22. And its 200-day moving average, $5.98, versus $12.88. It confirms a really violent breakdown of any prior uptrends. The chart readers are not happy.
All right, bearish sentiment is clear. Next, let's explore Chapter 5, Ownership Structure. Who actually owns this company, and what can that tell us about its prospects or volatility?
Okay, ownership is interesting here. Institutional ownership is relatively low, only about 18.5%.
That is low for a public company.
It is, and it's mainly passive index funds. BlackRock, Vanguard, State Street. They likely increased positions simply due to the prior price momentum pushing it into certain indices rather than, deep fundamental conviction.
So passive money mostly. What about insiders? Management, board members?
Insider ownership, however, is notably high at 22.23%.
Over 22%. That's quite high. Usually seen as a positive sign, right?
Yeah.
Alignment with shareholders.
Often, yes. It suggests they have significant skin in the game.
So, here's the question then. If insiders own so much, the stock just crashed by over 70%, are they buying the dip? You'd think they might step in if they believed the market reaction was totally irrational.
That's an excellent point, and it raises a really important question right now. Looking at recent SEC filings, there have been no open market purchases or sales by insiders in the last 12 months.
None. Not even after the crash.
None reported. And the absence of insider buying after such a dramatic collapse is, well, conspicuous.
Yeah, you'd think someone would see value if it was truly misplaced.
Right. If management genuinely believed the reaction was irrational, you might expect them to buy shares on the open market. Their inaction could be interpreted as maybe a lack of conviction in a quick rebound. Or, it could simply be due to trading restrictions or blackout periods. We don't know for sure.
Fair enough. So who owns the rest then, if institutions are low and insiders are high?
Well, the ownership structure is highly concentrated between those two groups and one other. Insiders hold 22%, institutions about 18%, and the general public holds the majority, around 59%.
Ah, so a large retail investor base.
Exactly. And this composition, with a large retail base and low institutional ownership, helps explain the stock's extreme volatility. Retail sentiment can shift very rapidly based on news, hype, or fear, leading to exactly the kind of dramatic price swings we just witnessed.
Okay, ownership explains some volatility. Now, let's get really practical with Chapter 6, risk assessment. We can use a SWOT analysis framework: strengths, weaknesses, opportunities, and threats. What are the key risks facing Neonode?
All right, SWOT. Let's start with the positives, the internal strengths.
Okay. Their core strength, as we've discussed, is that valuable IP portfolio.
Right.
Over 100 patents, that's the foundation.
Right, crown jewel.
Yep. They also have that strong balance sheet we mentioned, minimal debt, robust cash position, which the Samsung settlement will only bolster. That gives them a long operational runway.
Buys them time.
Exactly. And don't forget those external regulatory tailwinds for DMS in automotive. That's a clear advantage, pushing demand potentially their way.
Okay, so IP, balance sheet, regulatory help. But what about the internal problems, the inherent weaknesses that continue to plague them?
Yeah, the weaknesses are significant. The biggest ones are that chronic unprofitability and the history of declining core revenue from actual operations.
Can't make money consistently.
Right. They consistently have high cash burn, which makes them totally reliant on external financing, like selling more stock or these one-time litigation settlements.
Living settlement to settlement almost.
It feels a bit like that. And critically, their whole business model now has this heavy dependence on inherently unpredictable litigation outcomes. That is a really hard path to build predictable, sustainable growth on.
Definitely unpredictable. Okay, so with those weaknesses in mind, what are the big opportunities? What's the potential upside that could actually turn this ship around?
The pending Apple lawsuit is, without doubt, the single largest potential catalyst.
Big one.
The really big one. It could potentially be worth multiples of the current market cap if they win significantly.
Yeah.
Beyond that, securing new automotive licensing deals for their DMS technology could provide stable, long-term revenue, moving away from just litigation.
Right, actual recurring business.
Yes. And finally, the new CEO, Daniel Alexis. His background in commercialization at Ericsson offers an opportunity, at least on paper, to succeed, where past management struggled actually translating that IP into consistent profits.
Okay, Apple lawsuit, auto deals, new CEO. Now the flip side.
Right.
What are the major external threats that could really go wrong and sink this?
The biggest threat is obviously litigation failure. An unfavorable outcome in the Apple case could be, well, catastrophic for the stock price and the company's strategy.
Makes sense. What else?
There's also the threat of technological obsolescence. What if cheaper capacitive touch technology just keeps improving and eroding the niches where Neonode currently has an edge?
Good point.
And we mentioned the fierce competition in the DMS market from larger, more established players like Smart Eye and Seeing Machines. They won't give up market share easily.
Tough fight there.
And lastly, there's always the ongoing risk of sustained cash burn. If they fail to reach profitability soon, even with the settlement cash, they'll eventually need more money, likely leading to more dilutive share offerings that hurt existing shareholders.
Right, the dilution cycle again. What about the broader economy? Any macroeconomic or geopolitical threats we should consider for a company like Neonode?
Absolutely. General inflation could increase their operating costs, especially legal costs, which can be substantial.
Yeah.
Higher interest rates also impact valuation directly by increasing the discount rate used in models like the DCF, making those potential future litigation winnings worth less in today's dollars.
Good point. Affects the present value.
Exactly. And as a Swedish company with global customers and potentially global legal battles, they're exposed to geopolitical trade risks. Things like the U.S.-imposed tariffs of 2025, for example, could disrupt supply chains if they ever went back to hardware, or maybe even reduce royalty revenue from international partners depending on trade agreements.
Okay, lots to consider on the risk front. We've covered a tremendous amount of ground here, really delving into the intricacies of Neonode Inc. Let's try and bring it all together now in our final section, Chapter 7, Conclusion.
All right, let's synthesize. The bull case basically argues that the market massively overreacted to the size of the Samsung settlement.
The 70% drop was too much.
That's the argument. At around $5.98, the stock might be trading near its net cash value, especially after adding the settlement funds. This effectively gives investors a free call option, or close to it, on that valuable patent portfolio.
Interesting way to frame it.
Yeah.
The $15–20 million windfall funds the ongoing Apple litigation without needing further dilution, which is key. And that high insider ownership suggests alignment that management believes in the value. A major victory against Apple, the bulls argue, could lead to a valuation many multiples higher, rewarding this speculative bet.
Okay, that's the optimistic view.
Sure.
But what's the counter-argument? What's the bear case that suggests this collapse was actually justified, or maybe hasn't even gone far enough?
The bear case posits Neonode essentially as a story stock whose story has finally started to unravel.
The narrative broke.
Exactly. The Samsung settlement was far less than the speculators, the hype, hoped for. This perhaps suggests their IP's true market value, when actually put to the test in negotiation, is lower than previously imagined. Meanwhile, the underlying business remains fundamentally broken, right? Years of declining revenue, persistent cash burn. That hasn't changed.
The core issues persist.
They do. And the high short interest, the terrible technical breakdown on the charts, and crucially, that absence of any insider buying after the crash, bears see all this as signaling a justified loss of market confidence. From this perspective, Neonode is a potential value trap.
Looks cheap, but isn't.
Right. It has a strong balance sheet, yes, but maybe no viable path to sustainable profitability without hitting the jackpot on the litigation lottery ticket.
Okay, bull versus bear laid out. So what does this all mean for you, the potential investor or observer? We're back to that incredibly wide valuation range we talked about earlier, aren't we?
Exactly. As we saw, that educational DCF model spits out this extremely wide range, under $2 on the low end, over $20 on the high end. Where does it sit now? Around 5.98 cents.
So in the middle of nowhere almost.
Pretty much. At its current price, Neonode is clearly no longer priced for a massive, transformative legal victory against Apple. That hype premium is gone. Its valuation now reflects deep uncertainty.
Okay.
So this isn't a traditional value investment. You're not buying earnings or steady dividends here. It's a high-risk, potentially high-reward speculation purely on patent monetization.
And the Apple lawsuit is key.
It feels like the primary determinant of its future value. The outcome seems likely to be binary, a substantial gain for investors if they're successful in court, or potentially a substantial further loss if they fail, and that core business remains unprofitable. It's a knife edge.
Definitely sounds like it. So as you digest this deep dive, here's maybe a final thought to consider. In a world absolutely swimming in data and information, how much are you willing to bet on the unknown, on something as inherently uncertain as high-stakes patent litigation? Does a patent portfolio, however valuable it might seem on paper, truly create a sustainable business model on its own? Or is it merely a series of high-stakes lottery tickets that might or might not ever pay off? Something to think about. And that is our deep dive into Neonode Inc., ticker NEON. Ooh. If you found this insightful, maybe helpful in understanding this wild story, please make sure to like this video and subscribe to the stockanalytics.ai YouTube channel.
Yeah, definitely subscribe.
For just $4.99 a month, members get priority deep dives on specific tickers you suggest. And big news, over the next few months, we're actually covering all of the S&P 500 stocks, and members get exclusive priority access to those deep dives.
That's a lot of companies.
It is. And hey, if you want a one-off deep dive on a specific company you're interested in, just drop us a super thanks on this video, let us know the ticker, and we'll prioritize getting that analysis done for you.
And please remember, this analysis was generated by an AI system. It's for educational and informational purposes only and should absolutely not be considered financial advice.
That's right. Please conduct your own thorough research or consult with a qualified financial advisor before making any investment decisions.
Always stay curious, do your homework, and keep diving deep.